Welcome to the deep dive. Do you remember the start of 2025? It felt like, well, durable economic growth was practically a sure thing.
Yeah, trade winds seemed pretty calm, relatively speaking.
And that AI hype train, full speed ahead.
Absolutely. But fast forward to now, mid-year.
And suddenly, those certainties, they feel a whole lot less solid, don't they?
That's just the reality of markets, isn't it? What looked like a clear path 6 months back is, well, now it's covered in a fair bit of fog. Investors are definitely feeling a bit of whiplash.
Exactly. And that's precisely why we're doing this deep dive today. We're looking into the 2025 mid-year outlook, our mission. Pretty simple. Pull out the essential knowledge you need to navigate this shifting landscape and keep your wealth plans on track.
Yeah, and this report, it really tackles 5 key questions, things that are, top of mind for anyone watching the markets right now.
Think of it as your shortcut, maybe. Getting through the noise to what really matters.
Exactly. These are the core issues that are probably going to shape the investment environment for, well, the rest of the year anyway.
Okay, so what are these big questions we're digging into? First, should investors cheer or fear Trump 2.0?
The big one.
Second, we're looking at whether your portfolio is really, truly resilient enough for these growing uncertainties.
Crucial right now.
Third, is this the start of the downfall for the U.S. dollar's dominance?
Always a hot topic.
Fourth, and I know a lot of you are wondering this, why isn't anyone really talking about AI anymore? Seems like it just dropped off.
It does feel that way sometimes.
And finally, we'll try to get to the bottom of what's the actual deal with deal making right now? M&A, IPOs, that sort of thing.
Right. It's worth remembering, the initial reaction to the new U.S. administration was actually pretty positive.
Yeah, there was this expectation of policies that would, spur economic activity.
Definitely.
But that early optimism, it seems to have evaporated pretty quickly, hasn't it?
It really has.
The report points out a surprising sequence of policies. It looks like the things markets maybe view less favorably: higher tariffs, less immigration, those pretty big government spending cuts under the, what should we call it, the Deficit Oversight Group of Experts, or DOGE.
Right. Those have been rolled out surprisingly fast.
Yeah, and the focus particularly is on this new tariff strategy. So is this a reason for investors to be cheering or maybe reaching for the antacids?
Well, the market's initial reaction definitely wasn't a cheer. The uncertainty around these tariffs, it's caused a noticeable jump in U.S. policy uncertainty.
Okay.
And that correlates pretty directly with a drop in confidence both for businesses and households.
So those hoped-for benefits.
The tailwinds, yeah, more M&A, busy capital markets, those promised tax cuts, deregulation, they just haven't really shown up in the way many expected.
It's like the party invitations got lost in the mail.
Something like that. And instead, we're seeing these storm clouds gather specifically because of the tariffs.
Okay, so why so much specific unease about tariffs? What's the core issue?
Because fundamentally, higher tariffs, they tend to act as a brake on economic growth.
Right.
They push up costs for consumers, and they really squeeze company profit margins.
And the report actually puts a number on this.
It does. It estimates that once you factor in all the exemptions and adjustments, the U.S. effective tariff rate could land somewhere in the mid-teens.
Mid-teens. How does that compare historically?
Well, put it this way. That would be the highest level since Smoot-Hawley back in the 1930s.
Wow.
And that wasn't exactly a boom time for global trade.
No kidding. That comparison certainly makes you sit up and take notice.
Yeah.
But the report also seems to suggest that despite these tariffs, they still think the U.S. economy will manage, slightly positive growth.
That's their base case, yes.
Yeah.
They're forecasting sort of mid-single-digit growth in corporate earnings per share over the next 12 months.
Okay.
But, and this is important, it's crucial to understand how sensitive this is. If those initial, much more aggressive tariff levels, the ones introduced back in April,
Right, the Liberation Day tariffs.
if those had stuck around, the report is pretty clear. Both the U.S. and likely the global economy could have tipped into recession this year.
So a potential crisis averted, maybe. At least for now.
Dodging a bullet, hopefully. Yes.
Now, I remember back in 2018, the last sort of trade spat, companies adapted, right? They raised prices, shifted supply chains.
It did.
Why is this time potentially so different with these new tariffs?
It really comes down to the sheer magnitude scale. These proposed U.S. tariffs are almost 4 times larger as a share of GDP compared to the ones in 2018.
4 times.
Wow.
Yeah.
And that scale just makes it significantly harder for companies to pass those costs on or find new suppliers quickly or just focus on their high-margin stuff.
So the old playbook doesn't work as well.
Exactly. In fact, the report calls these announced tariffs one of the most substantial tax increases outside of wartime in U.S. history. That's considerable headwind.
Puts it in stark perspective. And
Yeah.
it's not just a U.S. versus one other country situation this time, is it? It's broader.
Exactly. The global nature of this really amps up the potential downsides. Look, in a one-on-one trade fight, a bigger economy like the U.S. usually has an advantage.
Sure.
Think U.S. versus Canada. Canada's exports to the U.S. are a huge chunk of their economy. U.S. exports to Canada, a much smaller fraction of ours.
Right.
But when you look at U.S. trade with the whole rest of the world, the balance relative to GDP is much more even.
So the U.S. becomes more vulnerable in a big global trade conflict.
Precisely. And this shift in vulnerability, it could be a key reason why non-U.S. assets have actually been outperforming U.S. assets so far this year.
That makes a lot of sense.
Yeah.
So while the U.S. is grappling with this, what's happening elsewhere? You mentioned Europe showing some unexpected positives.
Yeah, it's interesting. Despite some, let's say, strains in the transatlantic relationship, many European nations are boosting their defense budgets,
Oh.
geopolitical realities, and that increased spending is actually providing a bit of a fiscal boost in some areas. Plus, you've got regional industrial policies focusing on things like electrification, reshoring manufacturing,
So creating opportunities.
creating some interesting investment opportunities, yeah. Germany, for instance, shifting away from its usual fiscal caution to invest more in defense and infrastructure. The report thinks that could actually lift Eurozone growth a bit.
It's almost like these geopolitical tensions are accidentally creating some economic tailwinds over there.
Kind of an ironic consequence, isn't it?
Yeah. But back in the U.S., it's not just tariffs and trade, is it? What about these potential tax cuts we keep hearing about?
Right, that's the other side of the coin, potentially. There's ongoing talk among Republicans in Congress about amending and extending parts of the 2017 Tax Cuts and Jobs Act.
And the numbers involved.
They're big. The Senate's instructions for budget reconciliation suggest a potential deficit increase of nearly $6 trillion over 10 years if these extensions go through.
$6 trillion, that's
Yeah.
huge. Larger than a lot of major legislation we've seen.
It is. So the big question is, how will markets react to that kind of potential fiscal stimulus?
Well, equity investors might like it, right?
Mm-hmm.
More fiscal support, maybe higher corporate earnings.
That's certainly the potential upside for equities, yes. The report suggests it could mean a substantial amount of new annual fiscal support.
But there's always a but.
But fixed income investors might see it differently. Bond yields are already pretty high, relatively speaking. So they'll be looking very closely at whether they're getting compensated enough to soak up all that new government borrowing.
So more supply of bonds could push yields even higher, maybe.
That's the risk. Now, there's also talk of maybe some spending cuts to offset it, which could calm bond markets a bit, signaling fiscal responsibility.
But getting agreement on cuts, especially with fights over things like healthcare spending, that seems tough.
Very tough.
Yeah.
Far from certain. So yeah, it feels like a bit of a tug of war. Potential positives for stocks, but definite concerns for bonds.
Okay. Now, beyond the big headlines tariffs, taxes, the report also mentions deregulation. What's happening there?
Well, it might not be grabbing the front pages, but deregulation is quietly helping, particularly the banking sector.
How so?
The report suggests investors might be underappreciating these tailwinds. Large U.S. banks have built up a lot of excess capital.
Right.
And if some capital requirements get eased, they could deploy that capital. More lending, maybe, share buybacks, even more consolidation in the industry.
Like the Capital One and Discover deal.
Exactly. That recent approval is mentioned as maybe a sign of more M&A to come in banking.
So banks could be an interesting spot in the second half of 2025 if the focus shifts towards these more, let's say, pro-growth policies.
There's the implication in the report, yes.
Yeah.
And they also look at tech. Tech stocks have had a bit of a rough ride this year, haven't they?
Definitely a noticeable shift. The whole sector's underperformed. Even the Magnificent Seven are down year to date. Is the report seeing a potential rebound, a second win maybe?
Well, they emphasize that the underlying earnings for these big tech companies still strong,
Okay.
and valuations compared to the rest of the market are actually at their lowest point in a decade.
Lowest in 10 years. Interesting.
Plus, and this is a big plus, semiconductors seem to have dodged the tariff bullet, at least for now, they're exempt.
That's significant.
Very. And the expected earnings growth for the Mag 7 is still way higher than the average for the broader market. So despite those earlier worries about heavy capital spending,
The fundamentals still look pretty good.
the fundamental drivers seem quite robust, yes.
Okay, so let's sum up this Trump 2.0 section. Cheer or fear? What's the bottom line?
The report concludes that, look, the tariff uncertainty will pressure growth and profits over the next year, no doubt about it. But it doesn't automatically rule out a bull market. There's still potential for more investor-friendly policies to emerge later in 2025.
So hope for the second half.
Possibly. The key message really seems to be brace for volatility, get comfortable with uncertainty. But they do still expect key developed equity markets to hit new highs by mid-next year.
Sounds like that classic climbing a wall of worry scenario.
Pretty much. Which brings us perfectly to our second big question. Is your portfolio actually resilient enough to handle all this?
Yeah, we've talked about these conflicting forces, trade barriers pushing inflation up and growth down, but maybe fiscal stimulus pushing bond yields higher. It's confusing.
It is. And in this kind of environment, portfolio resilience becomes absolutely critical.
Why now, specifically? What's changed?
Because we're facing genuine two-way risks now. To growth, to inflation, plus this ongoing policy uncertainty. It's a real regime shift from the post-GFC world.
You mean the era of low inflation, low rates?
Exactly. Back then, U.S. equities were pretty much the main game in town for returns. Now, the dynamics are way more unpredictable. You need a more robust portfolio.
Okay, so what does a resilient portfolio actually look like in this context?
Well, the report defines it as having a mix of assets with low or even negative correlations to each other.
So they don't all move in the same direction.
Right. And crucially, each asset should have the potential to beat cash over the long run on its own merits. The main goal is just to reduce the size of drawdowns, the portfolio losses.
Regardless of what happens with inflation or growth or markets overall.
Exactly. Whether things go up, down, or sideways. Now, traditional core fixed income. Still important for stability if growth slows down.
And opportunistic credit.
That can help during times of economic stress.
Okay, so beyond those, what specific asset classes does the report highlight for building resilience now?
They focus on 4 key areas. First up, equity-linked structured notes.
Structured notes.
Yeah.
How do they work for resilience?
Think of them as investments tied to stocks, but they often have features offering some downside protection if the market falls.
Okay.
And their coupons, the income they pay, are often linked to market volatility and interest rates, both of which are expected to stay elevated.
So you potentially get a higher yield than normal bonds, plus some protection.
Potentially, yes. And the report mentions their clients are using these more and more.
Interesting. Almost like getting paid for the market uncertainty itself. What's number 2?
Hedge funds.
Okay, hedge funds, often seen as complex. Why them?
The report points to their potential for better risk-adjusted returns compared to just mixing stocks and bonds, looking at data from late 2019 to mid-2024.
Better returns for the risk taken.
Potentially. They expect slightly higher returns and volatility than core bonds, and this is key with low correlation to traditional markets.
Low correlation again. Which strategies do they like?
They lean towards less correlated ones like relative value, trying to profit from small price differences and macro strategies, which bet on broad economic trends, plus potential tax benefits for U.S. investors in some structures.
Got it. So that low correlation is the main draw for resilience. What's next on the list?
Infrastructure.
Okay, like bridges, power grids.
Exactly. The appeal here is often long-term contracts, many with built-in inflation protection.
Inflation protection is good right now.
Very good. And a big chunk of the return usually comes from steady income. That looks pretty attractive when the bond market is choppy.
Makes sense. Plus the long-term need for more power, digital infrastructure.
That's the secular trend underpinning it, a growing demand.
Right. Essential stuff. Okay, that's 3. What's the 4th piece for resilience?
Gold.
The traditional safe haven.
Exactly. Positioned as protection against geopolitical risk and also potential U.S. dollar weakness.
And central banks.
The report notes many central banks still hold relatively low levels of gold compared to history, suggesting potential for ongoing demand there.
Interesting. What about crypto? Bitcoin as digital gold.
They express skepticism about Bitcoin and other cryptos for portfolio resilience, mainly due to the high volatility and, their track record of struggling during big market sell-offs.
Okay, so maybe not for the resilience bucket. So the toolkit is structured notes, hedge funds, infrastructure, gold, alongside core bonds. It's definitely more than just the old 60-40.
Absolutely. And the report also stresses just basic portfolio hygiene.
Like what?
Like checking your asset allocation. Has market movement caused drift? Did your 60-40 accidentally become, say, 7,525 because stocks did so well.
Rebalancing, basically.
Rebalancing, yes. And also checking if you're maybe too concentrated in US dollar assets.
Which leads us perfectly to question number 3. Is this the beginning of the end for the U.S. dollar? We've seen it weaken a bit. There's always talk about its reserve status. What's the take here?
The report leans towards it's a significant shift, yes, but probably not an existential crisis for the dollar. Not the end of its reserve status, necessarily.
Why not? What keeps the dollar on top?
Well, they list the big reasons. The sheer size and stability of the U.S. economy, deep and liquid financial markets, rule of law, strong institutions, the security umbrella from the U.S. military.
Those are pretty powerful advantages, hard to replicate.
Very hard.
So why the recent weakness and the increased chatter about its future?
The increased downside risks really come from that tariff uncertainty we talked about and the U.S. fiscal outlook, that potential $6 trillion deficit increase.
Right.
There's this growing worry that U.S. policymakers might be, repeating some past mistakes, protectionism, maybe messing with central bank independence, things that have historically hurt currencies.
Like some Latin American examples mentioned.
They draw that parallel, yes. Protectionism, lack of central bank independence. But they suggest the dollar's erosion will likely be more subtle than a sudden collapse.
Why subtle?
Because of powerful network effects. Think about it. Most central bank reserves are in dollars. Most international debt is in dollars. SWIFT settlements rely heavily on the dollar.
It's deeply embedded in the global system.
Exactly. It's not easy or quick to replace. That said, investor perception is shifting. A high percentage now see the dollar as overvalued and expect it to fall further.
So a gradual slide rather than a cliff dive. What's the actual forecast then, near term?
The base case is for a few more percentage points of decline against major currencies by year-end, and the risks seem tilted towards even more weakness.
And historically, have there been periods of sustained dollar weakness?
Oh, yes. The 1970s, 1985 to 1992, 2002 to 2008. These were multi-year periods of significant depreciation.
And it wouldn't take much selling by foreign holders of U.S. assets to move the needle.
Exactly. Even a relatively small repatriation of U.S. assets held abroad back into local currencies could noticeably weaken the dollar.
Okay, so if you're an investor and you expect the dollar to weaken, what can you actually do about it in your portfolio?
Diversifying currency exposure is key. The report mentions the euro, the Japanese yen, and gold again as potential beneficiaries.
Yeah.
They also suggest exposure to euro and yen-denominated equities. Their long-term models indicate dollar depreciation could add an extra return boost for U.S. investors in those markets.
What about private equity?
Private equity can also offer geographic and currency diversification, but they do add a note of caution for U.S. investors about holding unhedged foreign currency bonds due to potential volatility.
Got it. So diversification is the main strategy. Is there a way to track market confidence in U.S. policy?
They mention one metric, looking at how often U.S. stocks, bonds, and the dollar all fall simultaneously.
Like a trifecta of bad news.
Kind of. It signals deep concern about policymakers' credibility. Thankfully, it happens less often here than in places like the UK or Brazil, but it's something to watch.
Okay, so bottom line on the dollar. Not collapsing tomorrow, but elevated risk of decline, and investors still have time to adjust.
That seems to be the message.
Right, let's pivot. Question 4. Why isn't anyone talking about AI anymore? It feels like the tariff talk just completely pushed it aside.
It's a really good question. The report suggests that, yes, the tariff uncertainty has definitely dominated the conversation lately.
But that doesn't mean AI isn't important anymore.
Not at all. Just because it's not the top headline every day doesn't mean the fundamental trend, the potential, has gone away. It's still critical long term.
And there was actually sell-off in AI stocks back in March, wasn't there? What caused that?
Yeah, that was largely triggered by a Chinese startup called DeepSeek releasing a new, very powerful AI model.
And why did that cause a sell-off?
Because it sort of challenged the prevailing assumptions about just how many resources, capital, chips, power you needed to build top-tier AI.
Ah, maybe it wasn't as expensive or exclusive as thought.
Or maybe it raised questions. It made investors wonder if the huge spending plans by the big hyperscalers, Amazon, Meta, Google, if those plans would actually deliver the expected returns, and on what timeline. It injected some uncertainty.
But those big companies, the hyperscalers, they're still forging ahead with those spending plans.
That's what they're saying publicly, yes. Amazon, Meta, others are sticking to their ambitious CapEx plans. And analysts have actually been increasing their growth forecasts for these investments.
So the conviction about AI's potential is still there.
Very much so. The belief in AI's ability to drive really significant productivity gains across industries seems as strong as ever.
And a lot of that is down to the progress in large language models, right? LLMs.
Absolutely. These models are now getting outputs comparable to, PhD level expertise.
Yeah.
But the cost to achieve that has just plummeted, down 80%, even 99% in some cases.
And that cost reduction is key.
It's pivotal. It echoes how other big technologies in history only really took off once the cost came down enough to make them practical for widespread use.
So AI is hitting that inflection point of affordability and practicality.
It seems like it. The report also mentions this dynamic of an AI race.
What's that?
Basically, all the leading labs and tech companies are racing to build the best, smartest, even self-improving AI models.
Competition driving innovation.
Right, and that competition could push prices down even further, encouraging even wider adoption. They also talk about agentic AI.
Agentic AI.
AI programs that can act more autonomously, make decisions, perform tasks, think smarter virtual assistants, more automated business processes. That's seen as the next big wave in software.
Potentially huge for productivity and consumer experiences.
Absolutely.
So, okay, the hype might be down, but the substance is still there. What about the bubble fears? People compare it to the dot-com boom. Is that a valid concern?
It's a fair question to ask, but the report argues that right now it doesn't look like a dot-com scale bubble.
Why not?
Mainly because stock prices, for the most part, have been rising along with actual earnings growth. It's not just pure speculation.
Okay.
And the big investments, the capex, aren't being funded by crazy amounts of debt or equity issuance like back then. That said,
Need to keep an eye out.
definitely need to monitor for froth, especially in related areas like, say, data centers. But recent earnings data is showing AI starting to deliver results. Microsoft's cloud growth, AI token processing going up.
Tangible results are starting to appear.
Exactly. So for investors, the focus should probably be shifting now
Towards what?
towards the companies and sectors best positioned to actually benefit from the cost savings and productivity gains AI offers.
Like software, maybe financials?
Those are mentioned, yes.
Yeah.
And also companies building those promising agentic AI applications. The core message is less talk maybe, but AI is still a critical trend to watch.
Okay, understood. Let's tackle our final question then. What's the real story with deal making? M&A, IPOs. There was hope for a big revival after the election. Did it happen?
Well, there was definitely an initial burst of optimism. The capital markets subsector rallied quite strongly. But that tariff uncertainty again, plus rates staying high, choppy equity markets,
Yeah.
it all kind of put a damper on those hopes.
So the IPO market has been quiet.
Pretty subdued, yes. And forecasts for U.S. M&A growth have been revised down. There were some early green shoots in global M&A, especially sponsor-backed deals.
Private equity deals.
Right. But the near-term outlook got clouded again by all the uncertainty.
What about the regulatory side? New chair at the FTC. Any change there affecting deals?
Well, the new chair decided to keep the Biden-era merger guidelines in place. That maybe wasn't what some market watchers hoped for.
No big rollback.
Doesn't seem like it. But there does seem to be more focus on consumer welfare in their decisions.
And what does that mean practically?
It could signal a slightly more market-friendly approach than the previous chair, maybe. Though big tech scrutiny is likely to continue, so perhaps a subtle shift, not a sea change.
Right. Subtle shift, maybe. What about private equity itself? How's that ecosystem looking?
There are some interesting things happening there. For a couple of years, private equity funds were calling more capital from investors than they were distributing back to them.
So negative net cash flow for investors.
Right. But over the past year, that seems to have flattened out. Net cash flow is roughly neutral now.
And what does that mean for deals?
Well, this slower pace of traditional deal exits, combined with funds holding on to assets for longer, is creating more opportunities in the secondary market.
Secondaries. Buying and selling existing stakes in funds.
Exactly. And that's attractive for a few reasons. It can lessen that initial J-curve effect where returns are negative.
Right, you get cash flow sooner.
You get more visibility into the underlying assets, and it helps with diversification. Plus, some big investors, like college endowments, might need liquidity, which could boost secondary market activity further.
Interesting. So secondaries are becoming more important. What about fund structures? Anything changing there?
Yes, evergreen funds are becoming more significant in private markets.
Evergreen, meaning they don't have a fixed end date like traditional funds.
Right. They offer more flexibility for deploying capital and for investors getting money in and out. We're also still seeing that trend of companies staying private longer,
IPOs happening later in a company's life.
much later. The median age for a company going public has increased a lot, and a huge chunk of high-revenue, high-growth companies remain private.
So if you want exposure to that growth, you need to be in private markets.
For suitable investors, yes, it underscores the importance of having that exposure.
Okay, so the private market is evolving. Are there any specific bright spots for deal making right now?
One area mentioned is sports investing.
Sports teams, leagues,
Yeah, deal numbers and valuations there continue to climb. Think about the Boston Celtics sale price or valuations for production companies like Omaha Productions.
and the appeal there, besides owning a team.
Part of it is the potential for returns that are less correlated with traditional financial markets.
Ah, another source of diversification.
Potentially.
So summing up deal making. Landscape is changing. Maybe consider a mix of traditional and evergreen funds, look at secondaries, maybe even niche areas like sports.
Exactly. It's about being adaptable and looking beyond just the traditional M&A and IPO headlines. The whole private market space is evolving.
Well, this has definitely been a deep dive into the 2025 mid-year outlook. You can really feel the uncertainty out there in the markets, can't you?
It's palpable, yeah. Investors are navigating a really complex, fast-moving world right now.
And the key seems to be
Having clarity. Clarity on your own goals, your capital's purpose, your wealth plan, especially your risk capacity and tolerance. That's the anchor in all this volatility.
we really hope that exploring these 5 big questions has given you, our listener, some useful insights. Hopefully helped you see potential opportunities within the uncertainty and maybe feel a bit more confident about sticking to your long-term plans.
Absolutely. And maybe the most important thing now is to take a step back and really think, how do these big global forces, the economics, the markets, the policies we've discussed, how will they specifically shape your investment decisions, your financial future?
Some food for thought as we navigate the rest of the year.